Welcome back. If you're just joining us, we are discussing the playbook, and this is a strategy document that has been published and produced by Genghis Capital. It outlines the macroeconomic outlook for this particular year, as well as the choice of equities or fixed income strategies that you need to take to be able to win in the year. Earlier on, we had an overview of what to expect with regards to the macroeconomic outlook. 5.7% is the number to watch out for with regards to GDP. All the other factors are more or less expected to be stable. With regards to the fixed income outlook, expect slight volatility, but then the focus is more on the short end of the yield curve to see a bit of volatility with regards to the yields in that case. Now for equities, that's our sweet spot and our focus for today's show. What do we expect to see, and where should you be putting your money in? Patrick Mumu, who's an analyst with Genghis Capital, is with us in studio. Patrick, take us through your outlook for the equities market for this year.
So the equities market outlook is quite positive. However, there are macroeconomic challenges which I've explained, one being the fiscal consolidation challenges, which might lead to upward pressure on yields. Second being the political environment, and third being private sector credit growth. So with these challenges, we're expecting some very short-term movement in the market, as we witnessed last year, very short-term fluctuations. If you look at the key counters, which I think are the bulk of the market, the key counters rallied towards in 4Q following the repeal of the caps. But what we are seeing rather from management from these banks, what we are seeing from expected results is not really coinciding with the rally which we witnessed. Currently, we are seeing a lot of profit taking on some of these counters, and it has depressed prices marginally downwards. And we're expecting that they'll depress further over the next 2 months, especially with the dividend period coming in. Most investors are hanging on for a period, and this is what is stabilizing some of these prices.
Some of these prices.
Yeah, for these counters, especially in the financial sector, which has the highest dividend yield in the sector, in the equities market. Yeah.
Okay. So when we're looking at performance, do we look at it in terms of how the NASI could perform or the NSE 20 index could perform? Do we expect double-digit growth in this year, similar to what we saw last year, or what are your expectations, at least when you're looking at the index?
So when you're looking at the index, last year there was, on NASI particularly, there was an 18.5% increase. This year the average will probably be around 10%, slightly below our model portfolio. Our model portfolio has been outperforming the equities market on average. In 2019, our momentum portfolio, for example, realized a return of 39.2%. Our income portfolio at 38% compared to NASI at 18%.
Oh, what do you mean by a momentum portfolio? Do you have in-house portfolios that you construct at the beginning of the year?
Yes, we have in-house portfolios for investors. The portfolios have different or similar characteristics within them. For example, in the momentum portfolio, here we're putting stocks which are very highly liquid, very sensitive to market movements and dynamic, and they attract a lot of foreign interest. So whenever there's news in the market, you find these counters tend to move much more or much faster than the normal counter. When you're looking at the income portfolio.
So what did your momentum portfolio do last year, and what do you expect this year?
Momentum portfolio did 39%.
Okay, and this is against the all-share index, which was up 18.5%. Okay, that is stellar performance. Well done on that portfolio.
And this year we're expecting that portfolio to do 20%, inclusive of the dividend yield, or the average yield on that portfolio is 4.7. On the actual price appreciation, we're expecting an average 15%.
Okay.
So the total return on that portfolio is 20%.
20%.
Yes.
For the investors watching, are you able to divulge the constituents of the momentum fund, or is that proprietary to your institution and to your own client base?
We're able to divulge them because we have put them out in the public. For investors to also assess them. These are the KCB, Equity, Safaricom, and EABL. Those are the most dynamic counters if you're looking at
the momentum.
Yeah,
so if you want to make 20% return on the stock exchange, you must read this report, and the counters look out for Safaricom, KCB, Equity, and EABL.
Yes, but there's a way that we have weighted them.
Yes.
Because if you play similar portions to all those 4 counters, you might not realize that 20% return. There's a certain way we have weighted the counters in a way that overweights counters where we expect significant upside, and that's what is skewing the portfolio towards that higher return compared to what would otherwise be expected from
Fantastic. So I guess that's a conversation that anybody interested would be possibly able to take up with you either through your Twitter handle or through your website.
Yes, certainly.
Okay. So we have the momentum portfolio, 20% return this year, 38% return last year. What is the other portfolio?
The other portfolio is the income portfolio. And income portfolio here, we're looking at stocks which are expected to have high, stable dividend, which is consistent. And the minimum yield you have set for the Q1 2020 quarter is 6%.
6%.
Yes.
Is that for one quarter only, or is that for the full year?
That one is for the first quarter. That implies if you're buying the stock now, because remember the prices will change. So in the second quarter, if prices are depressed, the yield will be higher. The yield demanded by investors will be higher. So based on the current prices, these are the stocks which currently offer the highest dividend yield.
Okay. So does that mean that every quarter you change the constituents of the income portfolio, or is it static?
Every quarter we revise the constituents of the portfolio and also revise the weightings depending on changes, because you might find during one quarter a stock has rallied and the upside which you are seeing has already been realized. So we'll replace it with a counter which more fits the characteristics of that particular portfolio.
Okay. So for this quarter ending March, I suppose, what constituents are making up this particular portfolio?
This portfolio is largely contained on the financial sectors. As I mentioned, they have the highest dividend in the sectors, and here we're looking at stocks such as Barclays, Standard Chartered Bank, Coop Bank, Kengen and KCB. Those ones are quite attractive. Okay. But again, we have weighted them in a certain way that really emphasizes the return.
All right. Is there another portfolio class?
We have value portfolio. We're looking at really deeply undervalued portfolios, and here we're looking for value. We're looking for stocks which are trading at significant discounts to their historical fundamental values, for example, price to book, price to earnings, and a minimum capital appreciation or expected capital appreciation of 20%. And these are bargain counters. They may have fallen out of favor with the market, so they are really cheap, or rather considered cheap. So that's the third portfolio, and it's a portfolio which has the highest expected potential return out of the income and momentum.
Okay. Yeah. And so that one you'll be looking at a return over 12 months, over a 12-month period.
Yes.
What is the return that you estimate for this year?
It's 45% for the value portfolio.
I want to put my money. I really, what makes up this portfolio? 45% is a fantastic return.
Yes, because most of the stocks in this category, they're really undervalued, trading at deep discounts, and we're expecting growth. They didn't really react to the market reaction which we witnessed in 4Q. Okay. 4Q really just saw financials and Safaricom
that was
gain.
The fourth quarter, yes.
But there are quite a number of counters which remained relatively undervalued and expected to grow this coming year due to a number of factors.
Oh, all right. Yeah. So 45% is what you expect for 2020. What did it do in 2019?
The value portfolio did 10%.
10%?
Yeah, so the performance was relatively weaker compared to the other portfolios. And this is because we had some reshuffles during the year on this particular segment. We had to remove some portfolios and reconstruct it. Yes.
And what is in the current portfolio today?
Currently in that portfolio we have Kengen. It's considerably undervalued. We have EABL, again a top counter also in the momentum portfolio, but didn't really react to market movements. Okay. And Kenyari, which is also quite depressed, operating at a 33% discount in price to book terms from the year average, and it's expected to do really well, especially with the income portfolio. It has a very huge investment in the equities portfolio, especially in the Kenyan space, and given the market rallied in the last quarter, it's expected to reap the benefits of that. So performance for Kenya is expected to also improve.
Rally
and that should be a really good call for investors. So we're banking on those really undervalued counters to move slightly or edge up higher from that return.
And then when you're looking at these portfolios, I can understand the constituents of these portfolios. When you're speaking to investors, how do you advise them in terms of what portfolio meets their risk profile? Is that a consideration or a conversation that you have with investors, at least retail investors?
Yes, definitely. You'd find investors who are just looking for income. In that case, they'll look at the income portfolio. There are those aggressive investors. They want to realize a very high capital appreciation, and that will refer them to the value category. There are those investors looking for really stable counters which will move faster than the market, factors which are fundamentally strong, that one will direct them to the momentum strategy.
Strategy.
Yeah, though we have come up with different other strategies, like you explained earlier, the directed strategy, try and give a different perspective on other strategies an investor can actually apply.
All right. We take a quick break. Look out for the closing bell. Don't go anywhere. Come back and let's understand what is your risk appetite and where can you actually make a few shillings, a few coins in the year 2020. See you in a few.